silver floating around the world that people think is backed by silver. And I would say it's a fraction of it. So this is going to be interesting going forward as the shortage continues. And if we see more turmoil coming out of the Middle East and Europe, as well as, let's say, this market crash that we're expecting to happen in this rest of this year, we could see that the silver market sees up. And then at some point in time, I really think the physical silver market saying we're already in the first stage of that.
Well, I think the cascading effect, yes, you are correct, but also look at how hard, I think one of the things that Steve Rocco mentions from time to time in his reports is just how hard mainstream media mocks gold, mocks silver, you know what I'm saying? Now, they won't do it to ETFs, exchange-traded funds, but they will look at gold. Well, Steve, just the performance of gold over the last 10 years has been remarkable, and we saw silver, did we not, you guys, go up 5% in one day? Let me ask the million-dollar question. How can anybody make any money putting their money in a bank? The answer is they can't. So why is that the case? Because the banks became basically security brokers, and they want your money in the market. Second question, these are rhetorical, and then, Steve, I want to turn it right back over to you. There is no way for a human being without supernatural words of knowledge and words of wisdom that can out-trade or outthink an algorithm devised and designed by hell to absolutely take away everything you invest. And Doug, I've mentioned this, and Steve, I've mentioned this. Maybe you've heard the interviews. I know people that shrug off losses of 400,000 and 500,000, and there are people I talked to a decade ago, and they just don't want to. Now, obviously, there are people that bought silver at 32. Now it's 16, and they're mad as all get out, But it's fascinating to me that they don't understand what they bought. They have something in hand. So, Steve, just your thinking on the overwhelming assault by the mainstream media on the physical ownership of the precious metals versus the absolute irony, if you will, of them turning around and recommending, paper assets, but never recommending the physical. I know the answer. You know the answer, but I want you to share it with the listeners.
No, that's a good point. And this is what I found interesting. Ever since when we had the QE, all the QE started, the quantitative easing programs, which is just another word for money printing. They started those after the 2008 crash. And so we had QE1 and then QE2. Well, when QE3 came, and when those different quantitative easing programs came along, the prices of the precious metals went up. So in 2012, we had kind of a balancing. They came off the high. Gold topped out at 1,900. Silver topped out at 50 in 2011. And then they both fell and were range-bound somewhat in 2012. Well, at the end of 2012, they announced QE3. And so everyone thought, well, we're going to see a continued rise in the price of gold and silver. Well, we had the exact opposite. It was like the door was shut. Well, all the QE went into stocks and bonds, and it went to prop those markets up because why? That's where the majority of investors are. Americans are invested in 401ks, they're invested in pension plans, they're invested in treasuries and municipal bonds, whatever. All that paper, that had to be propped up. Well, then, of course, the metals started to decline, and I think part of it was manipulation. So if you can get the oil price down, the metal prices down, the commodities down, you have less inflation. So since the end of 2012, we've had this disconnect. The broader stock markets have continued to go up, and then the commodities and gold and silver have continued to fall. And I think we're seeing the top of one, which is the broader stock market, and we're seeing the bottom of the other. But the U.S. retirement market in 2008 was $14 trillion, and it fell from $17 trillion in 2007. It fell to 14. Well, do you know, according to the Investment Company Institute, it's now over $24 trillion. So it's increased $10 trillion just the U.S. retirement market. Well, that needs to be propped up because that's where the faith in the system is. Well, in that same period of time, there has been global silver investment was $30 billion. The increase of global silver investment was $30 billion compared to $10 trillion to show you how small the silver market is compared to the overall paper Ponzi scheme, which is what I call it. So that's where we are right now. And I think we're starting to see a headwind as we had the crash in the Dow Jones last month. And I think what's happening now, people are starting to realize that this is a system that cannot be propped up. And we do know the Chinese are buying this. The Chinese government is buying stocks. The Japanese government is buying stocks. The U.S. government is buying stocks. And they're also buying their own bonds. So this can continue on for a while, but it looks like we're starting to see a headwind. And that's the reason why, gentlemen, I hear that more and more new people are calling up and wanting to purchase gold and silver, especially silver, because they don't trust the banks. They have way too much cash in the bank. And who knows if we're going to have a bail-in. So we are seeing not only small mom-and-pop investors, we're seeing multimillionaires now becoming worried because they may not know all the details of the precious metal market, but they know, why should I put all my money in a bank account? I'm not getting any interest. Because that has been correct, Steve. This has been the mantra. Why buy gold and silver? Because it's a dead asset. It doesn't earn you an interest. Well, if you put your money in the bank, you're not getting any interest, and you could be in trouble by getting a bail-in, and then you're going to have to pay them to keep your money in the bank. So I think we are now seeing a turn in the market, and I think as time goes on, as we see more bank regulation, of lower interest rates and maybe even negative interest rates, we're going to just see more demand for the precious metals. And I think this is going to get quite interesting towards the end of the year and into 2016.
One of the things, too, that I think people need to understand, the second most populous nation in the world is India. And India is fascinating because, Steve, you just did a recent report on the Indians. It's fascinating to me that obviously India wears their savings on as jewelry, gold jewelry. And by the way, people need to know this. No place in the world will they accept 14-karat gold as even anything approaching. It's almost held in contempt. They call it cheapskate gold. In order for something to be pure worldwide, it's got to be a minimum of 22 karat, preferably 24 karat. That just means pure gold. But share what's going on with this silver imports now from India, because that's pretty. Go ahead, Steve.
Yeah. Not only silver but gold, but let me just tell you, according to the most recent data, and it's phenomenal. India, the biggest demand for silver right now is in India and North America. India, for January to August this year, they've imported 1,800 metric tons, and that is 218 million ounces. It's actually up 96% year over year. Now, last year, India imported, and it was a high record amount. They imported like 7,085 metric tons, which was 228 million ounces. But already, January to August, we're at 6,700. And they actually import more in September and October because it's their holiday season. And so they're going to probably import 10,000 metric tons. And if we take the two largest importers in the world, which are the U.S., and the reason why the U.S. imports so much silver is the U.S. is a large industrial fabricator. China is, but China has a lot of silver production. They're like the third in the world. U.S. has much lower, so they need to import silver. But we have a very high industrial fabrication base. So our silver imports have been about 4.5 to 5,000 metric tons a year. So here's what's really fascinating. Last year, the U.S. and India imported 44% of mine supply. This year, they're on track to import 63% of mine supply, just these two countries. And what is fascinating about it, and I wrote about this in several articles, we all know that economic activity is falling second quarter. So I've been looking at the data. Industrial demand for silver is down. It just is. And jewelry is up a little bit, but not much. So the U.S. really doesn't need much more silver. So last year, the U.S. imported a little less than 5,000 metric tons. Well, so far, January to July, we're up 21%. We've imported 600 more metric tons of silver in the United States, which goes to show, what Steve is saying, there are big buyers buying this silver. It's not going into the market as in industrial demand or jewelry demand or silverware demand. It's going straight into the investment market. Now, this has caused a lot of stress on the overall global system. And another interesting thing about India, because India is importing so much silver and a lot of it is invested, I think they're trying to access it wherever they can. Now, I went back and looked at the USGS data, the U.S. Geological Survey. They do import-export for the U.S., for silver, gold, all metals. And for many years, so let's say the last 2 years, U.S. hasn't exported any silver to India at all. The most was 0.2 of a metric ton 1 month. That was the most. Some months it was zero. Well, something changed in May this year, and we exported 39 metric tons of silver to India in May. It jumped up 75 in June, and I knew when the data came out for July, it would be higher. We exported 113 metric tons to India. So we're seeing this. India is going to be the largest this year. It's going to be like 340 million ounces, almost 40% of total mine supply. So, and they're buying silver because they know it's a good deal at this price. And what is the difference between North America and the United States, and let's say India and North America? India is importing a lot of silver bar. They're investing in the silver bar. But North Americans, Canadian, U.S., and some European, it's mostly official coins and small bars. And I would imagine this year we're going to see over 250 million ounces, maybe even more. And so with all this that is taking place, India buying, importing so much silver, we're having a huge surge in silver investment demand in North America. It's putting more stress on the system, and we're seeing that in the exchanges. And the exchange registered silver inventories are falling. And, Steve, we talked about that, and I think they're going to continue to fall as in the next couple of months as there's more stress on the system. What do you think about that?
Well, I absolutely see it. For instance, I just got an email, Steve, and I do this I watch my email to see what people are responding to when we're talking about supply and demand. And this is one from somebody from Australia. He said, hey, Steve, my local coin store imported its silver from Australia, and he's talking about the kangaroos. They can't get any deliveries from this country. There are no more silver available. He wrote he should say there is no more silver available at the store. One mini monster box is already sold. A mini monster box is a new term, Steve, that people are, you and I know what it means, but some people may not know what it means. A monster box is referred to as the green factory sealed mint boxes that come from the U.S. Mint. Well, Australia did a neat thing with their kangaroos. They put them into 250 ounce or 250 coin boxes, and then they sealed each one of the 25 tubes of 20 with a laser holographic piece of tape, so they can also tell when a tube has been opened. Well, I can tell you this, that one of my suppliers, my main supplier, I think I told you this last night, that they had 100,000 ounces on Friday morning when I call. I call and get all my availability in the morning. And by that afternoon, it was all gone. So I think people need to understand. Of course, 100,000 ounces, that's a lot of money. You know, it was about $1.6 million worth. But when you see and we'll deal with this probably in the next hour, people don't understand that here, we'll make it simple. If there's only 10 ounces of silver in the world to deliver, how can anybody be selling 100,000 ounces against the deliverable 10 ounces? That's what happens all the time, and that's what the derivatives market has done. What I'm seeing, Steve, is absolutely beyond backwardation, where the spot price is greater than obviously the physical price, because I'm seeing something and talking to some very wealthy people. They are asking the same question you and I discussed. What happens when there's no clearance on risk to offset risk? Maybe people better understand this. As a dealer, and I've been in the metals market for 30-some years, I have to go to one of the world's distributors, you know, the biggest ones in the United States, but they also distribute all over the world. And they have to be able, if they sell me silver at $20 an ounce and it goes down to $18 an ounce tomorrow, they need to basically be able to hedge their bets. Hedging is a derivative. The word derivative is real simple. It's just a financial instrument derived from an underlying asset with value. Well, then we got into junk bonds, so you could say it's an underlying value of junk, okay? Either way, something's supposed to be holding up the value assigned to it. But one of the things that I'm the most concerned with, and again, I talked about it years ago, but here we are right now. The minute you were talking about a couple moments ago, Steve, you were talking about when the market seizes up. It's obvious that should there be no way for the primary distributors of the precious metals to hedge their risk and offset their risk, what happens then in the market? Well, number one, the market prices of gold and silver explode. And number two, it will come to that point where there's only two types of silver, that which you have and that which you wish you would have had. And I find it fascinating. People will immediately bail on if the price of silver is down, let's say 50%, but they still own it. Yet they don't even complain when they have paper assets that go from, let's just take Bear Stearns stock, $50 on a Friday and what, $2 on a Monday? So I want to get your feel on this question. This is critical, and maybe you can even define it better than I can. The day that COMEX defaults, or whoever clears and is able to clear trades on both sides of the aisle, in other words, buying and selling, you have to have a seller for every buyer. You have to have a buyer for every seller. So the point is that what have you factored that in to, let's just say, the next coming 6 months to a year, with if there is a severe disallocation, if the mines are closing, if the manipulation is so great now that the physical metals do not exist to supply all the derivative instruments written against them. I'm trying to make this simple. It's becoming complex. In other words, all there is out there is lies and no physical assets. I think this is everyone's worst nightmare from the standpoint of who wants to buy it, but it's everyone's silver cloud that has it. Can you put it in a simpler term than I just said?
No, you did a good job, and I think what we need to also include into what you just said was that the what's happened since 2011 and 2008 to 2011, gold has been going from west to east, and for the Chinese and then even in Singapore, Asian countries, we're starting to see more exchanges that were opened up there. Like the Shanghai Gold Exchange in China, believe it or not, they have withdrawn almost 2,000 metric tons have gone through the Shanghai Gold Exchange from January to September. I mean, China is going to import upwards of 2,600 metric tons of gold just this year. That's just through the Shanghai Gold Exchange. So, and in India, they're going to import 1,000 metric tons of gold. Total mine supply is like 3,100 metric tons. And they're going to, just those two countries, those two Asian countries, are going to consume 3,600 metric tons. So what's happening is the East is getting tired of the dollar. They're getting tired of the Federal Reserve printing money, and it's impacting the producers of the world. That's the BRIC countries: Brazil, Russia, India, China, South Africa, and even other South American countries. They're getting like a double whammy because we can print the money here, but their currencies fall. So we're seeing new exchanges being opened up in China, the Shanghai Gold, the Shanghai Futures Exchange, and so they are becoming more of a physical exchange. If you want to get a contract, then you're going to take delivery. Well, you see the COMEX, which is the U.S. and Canada's exchange for gold and silver. It's no longer a physical delivery market. Very, very little. There's only one depository in the COMEX, which is the CNT depository that acts like a physical depository. And they're the one that we've seen a big increase and also a huge drop in silver inventories over the last 4 or 5 months. So with that being said, when we see this movement of actual physical silver market, gold and silver markets moving to the east, the COMEX is the global pricing mechanism, but it's not a physical. It's not a physical market. It's a paper manipulated market. So it could default, Steve. We could just see it. It could just become. It could go out with a whimper, because a new mechanism, pricing mechanism, coming out of the east. And let me just now that we're talking about the COMEX, I noticed a fascinating trend. Now, for anybody who doesn't know what the COMEX is, basically there's 6 depositories in the U.S. and 1 in Canada where gold and silver is stored. J.P. Morgan is one. There's Brinks. There's Scotia Makata. There's CNT Depository. There's a Delaware Depository, and there's one more. There's 6 of them. Well, the total registered silver inventory, there are eligible silver inventories, and then there's the registered. They're both the same silver, but the registered silver is available to be delivered into the market. So the eligible may be a billionaire, or maybe a hedge fund, or maybe an investor, single investor, who's purchased silver, and they're storing it at one of these warehouses. And they don't want it to be put out in the market. They want to hold on to it. But saw the price of silver increase from, let's say, March 2010 to 2011. We saw a huge drawdown in the COMEX registered silver inventories. And I looked at it, and it was like it drew on average 1.8 million ounces a month. That's how it fell over that year and a quarter. Well, something's happened this year, and it started in April. It took 4 years for the registered inventory to build from their low of about 27 million ounces in July of 2011. It took 4 years to build to 70.5 million. And that was this year. April 2015, registered inventories at the COMEX were 70.5. Well, they're now at 43.5 million ounces a month. It's 3 times the rate they were when the price of silver was going up. And the price of silver has been basically the same.
Mr. Rocco.
Yes.
Hey, Steve, let's take it, first of all, the massive dumping of silver on the market by the federal government and metals and just the whole thing. And then we'll go into the question that we got about why are there dealers that seemingly have a lot of silver, and we'll explain it because it's not confusing. There's a difference between dealer inventory and manufacturer's ability to feed the pipeline. But let's go kind of like we talked off the air. So go ahead, sir. Take it from here.
Okay. There's the supply and the demand situation for any market. And that's kind of a commodity-based pricing. Okay, how much the supply is, and then how much the demand is. And if there's more